In 2022, you couldn't turn a corner without hearing anything about cryptocurrencies. Cryptocurrency peaked in November 2021 and has since plummeted in value, with Bitcoin falling from over $68,000 to below $20,000. In this video, we'll take a look at why crypto was doomed to fail from the start. It was all about meme stock searches and cryptocurrency in 2021. One may argue the same about cryptocurrency in 2022, but for very different reasons. To put it mildly, the Bitcoin market crashed. Macroeconomic pressures, scandals, and meltdowns took out riches apparently overnight in the business. As the year 2022 came to an end, many cryptocurrency investors were confused about the health of the sector. Cryptocurrency history has rarely been dull, but the 2022 collapse brought a series of shocks that rattled the foundations of digital assets. A series of blowups, including the May collapse of a so-called stablecoin and the epic unraveling of the FTX crypto exchange in November, resulted in a wave of bankruptcies. The occurrences damaged the faith of more mainstream investors who were eager to capitalize on Bitcoins and the notion of decentralized finance's burgeoning popularity. The upheaval has sparked calls for authorities to act faster to protect consumers. During the epidemic months, cryptocurrency became quite trendy. You'd often hear rags to riches stories of people becoming billionaires in a matter of days after purchasing meme coins, which were simply introduced as a joke. Shiba Inu, a meme coin, skyrocketed more than 700,000% in 2021, and one man came forward with a story about how he was able to quit his warehouse job since he was now a millionaire. Many more stories like this one emerged throughout the year, and it appeared like the cryptocurrency space was brimming with free money. According to CoinGecko data, after peaking in November 2021, crypto assets lost $2.2 trillion in the following year, with their combined market value falling by 73%. Previously, such collapses, often known as crypto winters, were caused by events within the business such as an exchange failure or a regulatory crackdown. This one started with something external: central banks raising interest rates to combat post-pandemic inflation, which dampened investor appetite for riskier assets like crypto. By being disconnected from the fortunes of traditional financial assets, the crash shattered the notion that crypto has a similar position to gold as a haven in times of economic turmoil. It came as a surprise to pension and sovereign wealth fund managers, as well as millions of small investors who had embraced cryptocurrency in recent years with the expectation that it would become a mainstream asset class. The 2021 crypto surge was constructed on insecure ground since many investors borrowed significantly to bet on digital currency and projects, frequently using other crypto as collateral. Because of this independence, high-profile failures have a broader impact. The greatest explosion included Terra USD, a digital token whose value was supposed to be tied to the US dollar through the deployment of a parallel currency, Luna. It gained popularity because users of the Anchor decentralized banking platform were offered interest rates of up to 20% on Terra USD deposits. Sudden withdrawals from Anchor lowered Terra USD's value, and within days, both it and Luna had entered a death spiral, wiping out over $60 billion in value. Companies that invested in linked tokens and derivatives, such as Three Arrows Capital, went insolvent, causing other companies such as Voyager Digital, which had granted Three Arrows a large loan, to fail. Another surprise came in November with the implosion of star entrepreneur Sam Bankman, CryptoFried's empire, which included one of the largest digital asset exchanges, FTX. The platform was essential in making cryptocurrency more appealing to mainstream investors. Bankman-Fried, who had bailed out other struggling crypto companies and become an unofficial evangelist for that technology at conferences and in the US Congress, saw his $15.6 billion fortune vanish in a matter of days. With inadequate record-keeping and poor centralized controls, FTX had a complex web of connected firms, including trading house Alameda Research. Many crypto ventures, according to critics, are doomed to fail because they rely on unsustainable returns. Some high-yielding projects were compared to new types of Ponzi schemes, with dividends to existing investors funded by deposits from new ones. The implosion of FTX highlighted the perils of contagion, in which difficulties in one sector of the industry spread quickly and unexpectedly, causing massive losses elsewhere. All of these could temporarily halt cryptocurrency investment. Following the 2008 global financial crisis, which weakened faith in traditional institutions, crypto was invented. However, the spate of scandals in 2022 begs a fundamental question about whether crypto can be trusted at all. Many people hoped that tougher regulation would restore trust. However, the FTX bankruptcy appears to have stalled legislation actively campaigned for by Bankman-Fried. Some DeFi platform operators argued that it was biased towards the interests of large centralized exchanges like FTX. Tougher regulation may one day make cryptocurrency a more reliable and reputable investment. What is unclear is how much of the industry can endure that kind of scrutiny. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.